Thank you for joining us. This is Alp Atabek, and I'm here today to review the extraordinary returns for 2019 and our 2020 outlook in terms of the markets and the economy. First, a quick few details. For asking questions throughout the webinar this morning, you will see a panel at the bottom of your screen. Please click on the Q&A or chat option and type in and submit your questions there. Either of those functions will work, and we will be monitoring any questions that come in throughout the webinar. Here's our agenda for today. We will start with a 2019 market recap and then review a few slides that do a great job of summarizing the current state of the markets, and then review our current outlook for the markets and the economy. Lastly, we will touch on a few of the provisions of the recently passed Secure Act that may impact you. Looking back on 2019, one thing is for sure, a lot happened. We ended the third quarter of 2019 with investor sentiment at 10-year lows, and 3 months later, we finished the year with investor sentiment and the U.S. markets near all-time highs, and the international markets rallying like they did in 2017 before the Trump tariff tweets began in January 2018. We closed out 2018 amid a deep correction, mentally bracing ourselves for 3 rate hikes in 2019, yet instead of 3 hikes, we had 3 rate cuts in 2019, and few, if any, see the potential for rate hikes in the foreseeable future. Additionally, we started 2019 mired in a trade war with China, and it's still going on, though now we have I'll call it a so-called phase 1 trade agreement in place, but there are no expectations of a more robust trade deal with China before the November election. Despite the proverbial wall of worry, Wall Street partied like it was 1999. It was hard not to make money last year, as you can see by the returns of the various indexes and sectors. In the U.S. markets, the S&P finished the year up 31%, its 6th best year in history. The Dow Jones Industrial Average up 22%, the NASDAQ 100 up 39%, mid and small caps up 26 and 23% respectively. On the international front, the Vanguard FTSE All-World ex-USA Index up 22%. The iShares Emerging Markets Index, which was directly impacted by the trade war with China, closed out the year up 18%. The EFA Index, which is Europe, Australasia, and the Far East, finished up 22% for the year. And surprisingly, the bond market posted stellar returns with the U.S. bond ag up almost 9%, which is unusual to see that type of return in the bond market with the equity markets up as much as they were. On to a few of the J.P. Morgan slides. This slide tracks the performance of the S&P 500 index from 1996 through December 31st, 2019. Inside the red circles is the forward PE ratio of the index at the various inflection points. In a little economics 101, here's how you calculate a PE ratio. You divide the price of a stock by the earnings per share of the company. For example, if a stock is selling for $100 a share and it earns $5 a share in profits, you divide 5 into 100, and that gives you a PE ratio of 20. The higher the PE, the more expensive a stock or the index is. Starting on the left side, on March 24th, 2000, which was the peak of the tech bubble, the S&P 500 index was selling at a forward PE of 27.2. That is on the high side historically. In the center of the page, on October 9th, 2007, at the start of the credit crisis, the forward PE was 15.7. Not expensive, but not cheap. Valuations were not the reason the market started selling off in 2007. There were a lot of other issues we were dealing with. On March 9th, 2009, the bottom of the market, The forward PE was 10.3. That's cheap. If you recall, Warren Buffett wrote an op-ed in the New York Times telling investors he was buying U.S. equities, and you should too. Fast forward to December 31st, 2019, on the upper far right side of the screen, you can see that the current forward PE is 18.2, indicating the market is no longer cheap, but still nowhere near the high valuations we witnessed during the tech bubble. Additionally, one could make the argument that a forward PE of 18.2 is reasonable in today's low interest rate environment. The next slide will help put the forward P ratios into perspective. This slide tracks the forward PE ratio over the last 25 years. On the left side, you can see how expensive the market was leading up to the tech bubble, and then you can see how cheap the market became when the market was selling off in the 2007-2009 time period. In the circle around the middle, you can see the 25-year average of this ratio is 16.3. On the right side, you can see that the ratio is moving progressively higher through 2017. The first big drop at the start of 2018 is due to corporate tax reform. The new lower corporate tax rates increased the profitability of companies, thus lowering the forward PE ratios. The second spike down reflects the correction at the end of 2018, which lowered the forward PE to 14.4, which had the market relatively cheap, which is why we had such a good bounce back. On December 31st, 2019, at a forward PE of 18.2, we are slightly above the 25-year average. At 18.2, our view is the S&P 500 index is not cheap, but at the same time, it's arguably reasonable given the current low interest rate environment. This is a new slide from JP Morgan that shows you how the companies in the S&P 500 are using their cash. Focus on the left side of the screen. This breaks down the percentages they are spending on buybacks, dividends, acquisitions, research and development, and capital expenditures over the last 13 years. You can see that the total spent in these categories has gone from approximately $1.3 trillion in 2009 to approximately $2.5 trillion in 2019. The gray shaded category represents stock buybacks, which is companies buying and retiring their own shares. This reduces the number of shares outstanding of the respective companies. In 2009, they invested around $300 billion buying back shares. You can see the percentages and total amount invested in buybacks has increased over the last 10 years. In 2018 and 2019, companies bought back a combined $1.5 trillion of their own shares, which is a major factor in why the markets have been moving higher. So what happens when companies buy back their shares? Well, quite simply, it just results in less shares outstanding, and a lower share count increases earnings per share and lowers PE ratios, which is attractive to investors. In addition, it drives up share prices, simple supply and demand. This slide illustrates the U.S. consumer is in good shape. An interesting fact, 68% of our country's GDP, gross domestic product, is a result of personal consumption. We need a healthy consumer to drive our economy. For years, we've commented that low mortgage rates are the gift that keeps on giving. Essentially, the refinancing of the American consumer has been a big driver in our economic recovery. Take a look at the chart on the top right. This is the household debt service ratio. This measures debt payments as a percentage of disposable personal income. At 9.7% at the end of Q4 2019, The consumer is in tremendous shape when compared to 13.2% in 2007. And what does a healthy consumer do? He or she spends money, which is good for the economy. All the charts on this page reflect a healthy consumer. You can see the balance sheets, household net worth, everything has really been just a huge positive for the economy over the last decade. This chart tracks unemployment and wage growth over the last 50 years. The December jobs report indicated employers continue to hire at a steady pace. Job gains averaged 176,000 in 2019, a tremendous number 10 years into an economic recovery. Employers have now added jobs for a record 10 years, which is the longest stretch seen in the 80 years this data has been tracked. At 3.5%, unemployment remains near historic lows, and December was the 22nd consecutive month with an unemployment rate of 4% or lower. While our unemployment rate is at a 50-year low, wage growth has been stubbornly slow for the past decade, which has puzzled most economists, but the rate of increase has been ticking up over the past few years, and you can see that on the bottom right of the screen. So why do we want wage growth? Higher wages translates into higher consumer spending, and as we've mentioned, the U.S. economy is primarily driven by consumer spending. A healthy consumer combined with wage growth is just really good for our economy. You should recognize part of this slide. The gray line is the performance of the S&P 500 index since 1997. We went over this on an earlier slide. It's now being overlaid with the MSCI All Country World ex-US Index, essentially the index for the rest of the world's stock market. What this chart shows us is the indexes frequently trade in tandem with each other. Same pattern, but sometimes the US outperforms and other times the international markets outperform. In the center of the page, you can see they traded in par with each other leading up to the credit crisis. They sold off together and then recovered together for a few years. From about 2011, it's been all US, and you can see that on the right side of the screen, with one exception. The international markets outperformed the US markets in 2017, but that was short-lived because the trade wars derailed the international markets in 2018. On the lower right, you can see the forward PE of this international index is 14.2, which is very attractive when compared to the 18.2 forward PE of the S&P 500 index. In addition, the dividend yield for this international index is 3.3% compared to 1.9% for the S&P 500. That too is very attractive. We believe in reversion to the mean. We don't know when it will happen, but we expect the international markets will play catch up to the US markets in the future. And hopefully, a few years down the road, you'll see this little gap between the two narrow. On to a little market history. This slide tracks the S&P 500 returns since 1980, as well as the largest intra-year declines over that same time period. The solid bar chart lines represent where the index finished in a given year, while the red dots represent the largest decline during the year. For example, on the far left in 1980, the index finished the year up 26%, but at one point during the year, the index dropped 17%. We have that marked with the upward pointing red arrow on the left side of the screen. Looking over the chart, you can see how normal it is to have larger sell-offs during the year. What's not normal is what happened in 2017 on the right side. While the index finished up 19%, the largest sell-off during the year was only 3%. You can see that red arrow on the right side of the slide. That small of a sell-off only happened one other time over the last 40 years, and that was in 1995. You can see the red arrow in the middle of the chart. When I look at the slide, I think it's just a great reminder that we have always had corrections in the past and will continue to have them in the future. We just don't know when they will happen. We are focusing on the right side of the slide, which charts the cumulative real GDP growth of the last 11 economic expansions, as well as the duration of the economic expansion measured by quarters or 3-month increments. The light blue line on the bottom is our current economic expansion measured from the peak of the previous economic expansion. So if you see this little blue line here and you see it dips down basically, the line starts in the 4th quarter of 2007. You can see the economy contracting during the Great Recession, and then you can see the long, slow growth economic expansion that has lasted for over 10 years, which is the longest expansion in history. Our view is the expansion can continue. As I said, while long in duration, the cumulative growth in the economy has been weak during this expansion. No signs of an overheating economy, which leads us to believe this slow growth economic expansion can continue. This is from the recently released World Bank Economic Report. We've listed their GDP forecast for various regions. In terms of the global economy, despite the overhang of the trade wars, the World Bank estimates global growth for 2019 will come in around 2.4%. And although this would be the lowest level since 2008, 2009, the World Bank projects global growth to uptick slightly to 2.5% in 2020 as trade pressures wane. For the U.S. economy, we saw U.S. GDP grow at a modest 2.4% rate in 2019. However, the World Bank expects U.S. GDP to slow to 1.8% in 2020 due to the negative impacts of earlier tariff increases and uncertainty surrounding the final trade agreements with China. Although euro area growth is anticipated to slip in 2020 to 1% as a result of weak industrial activity, the emerging markets and developing economies are expecting to rebound to 4.1% growth in 2020 from 3.5% last year. Overall, while growth may be slowing in the U.S., the World Bank is not forecasting a recession in the near term. Now, you've heard me say the U.S. and global economies continue to grow. The jobs market remains robust. Interest rates remain very accommodative, and valuations, while creeping higher, may be justified in today's low interest rate environment. So what worries me? I mentioned that last year Wall Street partied like it was 1999. That bothers me. Today, similar to 1999, right before the tech bubble burst, many tech stocks are moving higher on a daily basis, and analysts are responding by raising price targets, adding more fuel to the rally. To borrow a phrase from former Federal Reserve Chairman Alan Greenspan, this indicates a bit of irrational exuberance is entering the markets, which typically means we are moving closer to another meaningful correction. That being said, be prepared for such an occurrence. The markets do not move up in a straight line, and the occasional correction is healthy for the markets, especially when we see signs of complacency entering the markets. For long-term investors, nothing has changed. We expect this record-setting, decade-long economic expansion to continue as long as monetary policy remains accommodative and inflation stays in check. Now on to a quick overview of a few of the important provisions of the recently signed Secure Act. So this is one of the biggest changes. They changed the age for RMDs. So they raised the age for RMDs from retirement accounts from 70.5 to 72. And this impacts individuals who attain age 70.5 after December 31st, 2019. So if you've already been forced to take RMDs, you have to continue regardless of whether you're 72 right now. Another big change is you can now contribute to an IRA after age 70 and a half. This is effective for contributions made for tax years 2020 and beyond. The only requirement, you need earned income to make a contribution. So this is a nice tax law change. One little word of caution is if you're one of the early birds that make their IRA contributions right after the start of the year, you might have had a problem making a deposit in early January because a lot of the software programs where they code deposits in, if you were already 70 and a half, they were not allowing people to make deposits. They had not updated the software yet. So we think most of them have cleaned it up at this point, but it was something of interest. This is a big change for inherited IRAs in 2020 and beyond. If you have kids and they are listed as the beneficiary for your retirement accounts, this new tax law may be costly to them. IRAs inherited in 2020 or later must be distributed over the course of 10 years when they previously could stretch the distributions over their lifetime. There are some exceptions to this rule, but this is a big change, especially for those with large retirement account balances. If you do not think you'll need all the money in your retirement accounts to maintain your standard of living during retirement, there may be some planning opportunities that you should consider. For example, if you are in a lower tax bracket than your beneficiaries, or if you live in a state with no income taxes and your beneficiaries live in a state with high income taxes, it might make sense to do a Roth conversion or partial Roth conversion. This is fairly complicated. It takes a lot of calculations, so it needs to be evaluated on a case-by-case basis. Let us know if we can help you with that. But it does open up a few planning opportunities, as I mentioned. They made it easier for part-time workers to participate in 401k plans. This change benefits part-time workers that have been excluded from participating in their employer's 401k plan because of their part-time status. In simple terms, the new rules make it easier for part-time employees to participate in their employer's 401k plan, and it's effective for plan years beginning in 2021. So not this year, they give them a little time to set up. It will impact things next year for part-time workers. This is a simple change. You can now withdraw up to $5,000 from your IRA or employer-sponsored retirement plan to help pay for adoption expenses. You still have to pay taxes on the distributions unless it's from a Roth account. The big change is the distribution will not be subject to a 10% early withdrawal penalty for distributions prior to age 59 and a half. Again, a nice change there. This is a nice change for anyone with student loans, and there is a nice planning opportunity available with this new tax law change. If you live in a state that offers a tax deduction for contributions to a 529 plan, such as Maryland, DC, and Virginia, you can contribute $10,000 to a 529 plan and then take the money out to pay down your student loans. In Maryland, a $10,000 contribution to a 529 plan could save you $800 to $900 in Maryland taxes. That gets spread out over a few years. So it's worth the paperwork to do this. And basically, you'll be taking some of your student loan payments, putting it into the 529, and then taking them out to make the payments on your student loans. And this will basically allow you to get a deduction. It's on your state income taxes, and it basically is for states that allow deductions for contributions into 529 plans. So talk to your tax advisor to see if you qualify. Oops, excuse me. This is a nice change for anybody. Hold. Already did, I apologize. Skipping ahead. So if you have any questions, let us know. I'll check them real quick.
Okay.
Actually, I got one that came in. I got one about just asking about interest rates, if it's a good time to refinance. So I'm going to say that we've generally felt that with rates as low as they are, it's a good time to refinance. We expect mortgage rates to stay around this level in the near term. It's too hard to speculate if they're going to go even lower. So if you're paying a relatively high interest rate in your mortgage, I would tell you it's a good time to go ahead and refinance. And if you can afford a higher payment, you should consider looking at a 15-year mortgage. The interest rates are lower on the 15-year mortgages than the 30-year mortgages. Of course, you'll have a higher payment, so if you can afford it, it's worth doing. One more question on international trade. And it says, what concerns you regarding international trade? And I guess they're probably referencing all of the, I'll say, trade discussions with a variety of countries. Not trying to get political here, but I will say the unpredictability of the Trump team's trade tactics makes it really difficult to feel secure about international investing over the short term. So we think all the international trade agreements will get put in place at some point. They'll all get finalized and we'll move over this period. But in the interim, at times, if Trump makes or if he does a trade tweet that just doesn't bode well with the markets, I will say you could see some pullbacks. So that worries us a little bit right now. If you have any other questions, feel free to send us an email or call us. Thank you for your time today, and we look forward to our next webinar. Take care. Bye-bye.